Good morning, boys and girls. Welcome to the Flow Show, Wednesday, 21st of January. Oh, feeling a bit middle of the weekish today, I can tell you. I was all full of beans yesterday and that's all evaporated as we get to the middle of the week. How are you faring, Kay?
Yeah, morning, Ryan. I'm all good, mate. Yeah, it's been a week already. I'm working on a new business plan for us. I think I'm going to sell high-end virtual Japanese knives to cut through all the noise that we are hearing these days, and I think it's going to be a great, big, beautiful business plan.
Oh, cool, mate. Yeah, I'll buy a few of those. I'm going to get into the yachting business, I think, given the weather we've got over here.
Oh yeah.
And kids had to get a boat to school this morning. Absolutely horrendous. Horrendous. I can't remember the last time I saw the sun. It's terrible. That's probably why I'm feeling so moody. Well, no, I'm not feeling moody. I'm just feeling a bit, non-energetic, shall we say. Anyway, there's trading to be done, news to get through. So let's start off. China Securities Journal piece had folks saying that they may delay a policy rate cut, that they may do a bit of tinkering and reduce their 5-year LPR rate, which they kept on hold earlier this week. So this has been a bit of a on-off conversation, shall we say, since probably the second half of last year. But their numbers looking like they may hold off any big cuts, but might do a little bit of tinkering, as I say. Over in Japan, everyone's jumping on the bandwagon regarding what's going on in markets. DPP's Tamaki says the government and BOJ should act decisively against excessive market moves. The BOJ should or could slow the pace of tapering to stabilise markets. Chief Cabinet Secretary Kihara says closely monitoring market trends, including long-term rates. We have potentially had a bit of support coming in for Japanese bonds. Sumitomo, which is one of Japan's second largest bank, said it's prepared to increase its Japanese government bond portfolio to as much as double the current $67 billion, which is 10.6 trillion yen, after it has made a full-scale return to the debt and global markets. That's according to its head, Nagata, after an interview. The Rengo Union has said that it wants the government and BOJ to stabilise prices and FX. Says the current weak yen is accelerating import-driven inflation. Says the environment for wage negotiations this year is not bad and feels confident overachieving around a 5% wage hike so far. The yen index today, or from yesterday, 73.79 from 74.02, just reflecting the rally we saw in yen pairs yesterday. Kate, we've been talking about this for, probably nearly a year now, about if the big boys get into the JGB market. First indications, it seems.
Yeah, interesting, I would say. And we had a quick conversation about that in our newsroom as well. It could create some volatility, but not the volatility in other bond markets that some people may hint at. So another article about they needing to sell, I don't know, $130 billion worth of treasuries or whatever amount when the Japanese decide to go back home. The thing is, we've seen that when the Japanese whales, you include the mega banks, which this one is one of. When they moved out of that longer end market, they actually went into different instruments, but all of them shortened their maturities, and they likely went also deeper into equity markets. So I there may be some flows obviously going through the longer end treasuries or so, but I think it's more the volatility could more be found into actually the shorter end bills, because as I said, shortening those maturities is they probably went a bit deeper into bills and maybe even short-term European bonds also to transition or to while waiting for the Japanese yields to go back up. So maybe there's a bit of a different volatility or different repatriation to be seen than what some of market players or bank strats expect. But yeah, it's interesting. We've been talking about that. When will they be ready to dive back into their own market? Maybe we see the premises of it, as you say, or the start of it very soon, which should be interesting because the giving the liquidity in there, which has been really lacking a lot. Is should be a positive, um, especially for the government, because that's going to give them something to rely on, a stabilization of the market, and they may then look at other things that they have to do.
Yeah. So two questions or two thoughts I've got is
Mm.
one, if they do shift, would they really shift out of US bonds? I mean, if you just take sort of tens as a guide, 10 years, you're still getting 4.28%, or you are
Mm,
getting 4.28%. If you look at
mm,
Europe, we're all 3.5, three fours, whatever. So you're getting better yield if you stay in the US, and maybe you do better getting out of Europe. And also, the ratios closing
mm.
between Japanese tens and others. And if you're staying in Japan, yeah, you may give up a bit of yield, but you're not facing the FX
Yeah, it
volatility. And
a lot will depend on hedging costs, what they say.
yeah,
Real interest rates versus well, the real interest rates, which are interest rates versus inflation, and then the swap rates, of course, which are also coming into consideration. But as you also say, being home, and they're not going to stick only to 10 years. I think the hint there is that they may start to look back at 2030s or so, JGB yields, because they have to, they need return
yeah,
just to support the aging population demands. And so they are going to be going, I think, in where really they get the highest possible yields. I think it could have a bit of an effect on the yen, just the fact that Japan is returning back home in parts. But to reply to the other question, I don't think that they will massively move out of US bonds, because it's been their main foreign investment vehicle, and they can't solely rely on what's happening in Japan. So there's never going to be a massive leaving the US markets. Okay, with everything that's going on, people may be tempted to think, yeah, well, that's another step in the sell America thing. I don't think that the Japanese are looking at it that way. They're rather
yeah,
looking at exactly what they can get at home. And let's not forget that they have been also enjoying, despite the weaker yen, but they have enjoying a very very profitable Nikkei market as well. Yeah, the local equity markets have been doing really well. So expressed in yen terms, which is their base currency, it's rather that side that we still need to look at, rather than its panic stations in the US bond market.
yeah. And my second thought quickly was, do you think someone's had a word in the ear roll of the Sumitomo chief and said, put a couple of comments
Could be,
out?
could be. I mean, I haven't seen because okay, the Japanese mega banks are always going to be pretty close to the government, but then I'd rather would like to, if we would get any indication about what the people like GPIF are going to do in the new fiscal year. They are the ones that usually are spoken to, because they are massive, right? And they can really them and the Japanese insurers really can support the market even more than what the Japanese mega banks could ever
Yeah.
do.
Yeah, absolutely. But anyway, we've got a little bit of a pause in this rally in yields in Japan. We're seeing the same thing globally as well. But as you can see there, these yields coming down in basis point terms, percentage terms, far more than what we're seeing elsewhere. Let's see if that
What?
continues. It pushes intervention just a couple of inches back, I think.
Yeah, unless the JGB market is more like a BOJ thing where they could decide to buy some unscheduled bonds. Staying in Japan, if I may, the green light has been given to restart the biggest nuclear plant over there, and I've been speaking about that as well, like over the past years or so. But due to security for security reasons, those restarts have been either pushed back, and also the logbook is gigantic to be able to even restart them. But they are accelerating the restarts, and it's also part of the plans of the well, even the older. The former government, but certainly in Takaichi's plans to push for the restarts of those nuclear plants. So that is another thing that I think we should keep an eye on because it could all be part of the puzzle as to why over time, I'm not saying it's now, and I still don't think that it's ready to really turn around, but it may be just part of the big puzzle why yen may actually start to do better as the year progresses. And just some things to keep an eye on, because we know that restarting the nuclear plants is going to reduce their reliance on foreign energy, which is going to be quite important for the local economy as well.
Yeah, and a big part of their inflation stuff going on as well,
Absolutely.
imported inflation. Right, moving on. We had some data out of the UK. Have I even got my calendar set up? No, every day this week. Bang, bang, bang. So we've had CPI out from the UK, and that continues to be sticky. We had headline CPI coming in higher. 3.4% was expected to rise to 3.3, but it came in 3.4. The core, though, that stayed unchanged. That was expected to rise to 3.3 as well. There's lots of chatteriness about various seasonal factors, airfares, this, that, and the other coming into this. So it's almost been brushed under the rug. Long story short, though, those numbers are still high. Bank of England is expecting this to fall off a bit of a cliff in this year. Whether they get their wish is another question, and whether it stops at their lovely 2% target is a secondary question we need to keep an eye on. But for now, it still remains sticky. Some of the other measures there as well, PPI, RPI, all staying sticky. Bank of England's Bailey was waffling financial stability shindig yesterday, so no monetary policy comments. He did say, though, that we have seen more hedging of dollar positions than investors saying they don't want dollars. So that's his view of the dollarization trade, or whatever you want to call it, at the moment. S&B's Schlegel says that negative inflation prints are well possible this year. That's pretty much chapter verse and what they were saying for last year as well. He said a few months of negative inflation would not be a problem. The bar to go negative on rates is high, but we can go negative if needed. ECB's Vilroy says Chinese imports are contributing to lower inflation. Makes no mention, obviously, of the shitty economy that they've had. That has an effect on inflation as well, but they'll ignore that and blame the Chinese instead. It is the 21st day of the new year, and Germany's already cut their growth expectations, or are about to, according to Reuters. They're going to cut their 2026 GDP forecast to 1% from 1.3%. So much for the new year positivity that we saw from the zoo report yesterday. Growth forecasts already getting cut. We had the old ADP weekly thingy coming in for week ending 27th December, and there was an 8,000 job gain versus a prior 11,250, whatever that means for the monthly number. Bank of America's Moynihan says the first couple of weeks of January, US consumers spent 7% more than last January. Obviously, that could just purely be in price terms rather than, volume terms. Obviously, inflation in the pipe there. But again, it doesn't seem like the US consumer has stopped spending in the early part of January. We'll find that out next month when we get the retail sales. Over to all the Davos drawl, as I'm calling it. Treasury Secretary Bessent has been quite lively. He's speaking every day so far. He says Europe keeps buying refined Russian oil from India. So jot that down on your next thing that Trump will probably have a moan up about. This I found quite funny. He said the Danish position in treasuries is irrelevant, a bit like the country. Says he's been in touch with Japan and they will stabilise markets. Lutnick's been, he might be back from the holidays now, he's been missing for a while. He says if Europe retaliates with tariffs, then we'll be back to a tit for tat possibility. He says US rates are hundreds of basis points too high. If we cut interest rates by 100 BPs, we would see the US grow 6% or more. Yeah, whatever. French President Macron, interestingly, turned up with wearing a pair of sunglasses to his speech. People wondering if Mrs. Macron had been swinging haymakers again as he was getting off the plane. Very strange turnout, that one. He says we need more Chinese investments into Europe in key sectors. The French Foreign Minister says France supports EU Parliament's wish to suspend the EU-US trade deal. Now, Macron made a comment about China. Reeves has also made a comment about China. Says it's not in Britain's interest not to engage with China. So it seems like a few countries might be trying to fight Trump by going down the China road in terms of relationships. It's been happening. Carney's been over there. Starmer's got a meeting with Chinese counterparts coming up soon as well. So everyone's just playing that political game. Reeves says she's confident on a plan to grow the UK economy is the right one. That's amazing because no one in this country has any idea what that plan may be. Here's a line as well. She doesn't think we'll need to do more on tax and is not planning any tax changes in the spring. I'm sticking that one on a post-it note on the side of my PC. ECB's Lagarde says uncertainty is back. Trump threats are a movie we've seen before and that Eurozone inflation is under control. Right, so if you were out and about with us yesterday, you would have seen the headline that a Danish pension fund, I'm not even going to try and say their name. Okay, I will. Academic Pension, whatever you want to call it, put up a headline that they're going to exit US Treasuries with a CIO saying the US is basically not a good credit. It also dropped that they only had apparently 100 million in treasuries at the end of December. So not exactly a big deal. However, that did spook the market a bit, because everything that's going on with, this talk of everyone diversifying away from the US, is it going to spark contagion? Is other funds going to exit out of US Treasuries? It came a bit later, though. They put out some other comments saying that the decision to divest in US Treasuries is rooted in poor US government finances, not directly related to the ongoing US-Europe rift. Obviously, someone in higher power had a bit of a word in the ear, or whoever released the initial comments. Again, talking about the size, they have around 22 billion under management. Then we had the head of Guggenheim Investments disagreeing at the Davos. She had a Davos speech there with a Danish fund that's selling USTs. So obviously didn't want her positions to be trifled with. They have 330 billion under management, so slightly different kettle of fish there. Kay, anything out of Davos you picked up? I mean, it's quite funny with that Danish pension fund news.
Yeah, well, we heard from PIMCO last week that they also thought that there's going to be a bit of continuation of not really leave America, but rebalancing. It's all like been ongoing already because we've seen that basically since Trump took office, right? But yeah, I think it's a bit of a storm in a teacup. Yeah, unfortunately, I missed that spike on the euro dollar because I would have been really happy to take the rest off on such a spike, but I completely missed it. Those 15 seconds of excitement. Yeah, size matters in those things. So yeah, for as long as I mean, Guggenheim is a bigger one, of course. So if you want to name names, for as long as you don't hear like PIMCO going completely out, or if you hear something like the I don't know. Yeah, well, the worst would be BlackRock, of course, because they are the biggest globally. But they've been pretty silent about all this, understandably, because Rick Reader is still in the hat for the government FOMC chair role. Yeah, yeah, and we could call it an ongoing small process, but it's not being totally disruptive of markets yet. If you look at, just take for example the currency. Yeah, euro dollar is higher than last year. That was to be expected. That was what I expected as well. But we are not trading 120 yet, right? Or there's no big exodus of the dollar, because if that would be the case, even the yen being weak, dollar yen would probably not be at 158, but closer to 152, for instance, right? So for the time being, yes, it's a kind of a move, but I wouldn't say it takes the form of panic stations yet. Everybody running for the exit. If we will see what happens the next few weeks on because let's not forget that Trump is in Davos. We don't know what's going to happen there. So maybe the market is also waiting for a more news to see whether it's warranted to move out a little bit more. Yeah, Fred says about gold. You have a few instruments that express this kind of fear, but it's not yet fully transpiring in FX, right? Because that would be the end of the funnel where everything kind of comes together. Because if you for instance sell US bonds as a foreigner, you're going to get dollars, and then either you swap them, which is going to have a very little effect on FX. But if you decide to sell them out and then buy your own bonds or your own bonds back, for instance, if you're a European asset manager, then it would really start to have a deeper effect on the dollar. But we haven't really seen that yet, okay, apart from the some instruments. And the only one really in effects that's really reflecting it right now is perhaps the Swiss franc. But let's also not overdo it. We are not like dumping 2, 3, 4% in stuff like euro Swiss or dollar Swiss either. We're still somewhere in ranges. So for the time being, I would say not yet at panic stations.
Yeah, thanks, mate. Right, we haven't got a lot of data coming out today. We've got pending home sales, construction spending, a bit of PPI, RPI data, PPI, IMPI data from Canada. We do have a full slate of Davos speakers, including Mr. Trump again, who went on his usual waffle around in a speech last night. So we'll keep an eye on that stuff. Now, we didn't get anything from Scrotus yesterday. They built up the excitement for us again and pulled our legs out once more. So we didn't get anything on this tariff case yesterday. There is chatter. There was prior chatter that there might be something today. That doesn't look to be the case now. And now there's fresh talk that we might not get anything until February. So who fucking knows with this lot? It's complete shambles. However, we do have something we need to pay attention to, and that's Fed's Cook up in her court case. Now, this is all about the ability to sack people at the Fed. So this is potentially a big deal. We're going to hear opening arguments. So it's not necessarily rulings, opinions, or anything like that. We're going to hear the case from both sides and what it means. Powell has chosen to attend, not in any witness capacity. He's just going to be sitting in the gallery as a bit of support, which you can draw your own conclusions from that. So it is something that if we do get any headlines, again, the question of Fed independence is really what this is all about. And if we do get any event headlines, then we're probably going to see markets move. I'm not exactly sure what time we're going to get all that palaver. I'll have to check it out. If it's SCOTUS, maybe it comes out at the same time, around 10 a.m. Eastern, 1500 GMT. But I'll look into that further. So that's what we've got coming up for that. Lastly, Ukraine stuff. Just before we kicked off the show, US Special Envoy Witkoff says there's lots of progress been made in the Ukraine-Russia situation in the past weeks. He will see the Russians sometime on Thursday. He says land deals are the biggest sticking points that remains. So that thing is still ticking over. That's it. Anything else, Kay?
No, mate.
Good,
no,
good.
Mate, no, mate. That's more than plenty enough.
More than plenty. That's what I like to hear. Right, let's have a little mooch around. I'm going to start in the Euro because everyone was getting pretty excited about this rally that we've had this week. I've been pointing out on the show, that was my watch level, 1740. We hit it. Stopped there initially yesterday afternoon. Then that was the spike on that Danish headline, which happened while we were all sitting on face. Then it hit it and stopped thereafter. I am in a little bit of short after I saw that secondary move there. Does it mean this rally is dead now? Not at all. But this was a level that was I was looking at a sort of right. If you're gonna bust a move, okay, that's the one you've got to take out. To keep going. The fact we haven't might be a bit of an indication that it's not going to be plain sailing all the way up to 120. But as I say, it doesn't mean the rally's dead. We're just holding the 117 area at the moment, which was been a former support and resistance point. So this keeps the rally alive, gives it something to build on if it's going to hold here. If we do, and we get another move up here, then there's the possibility of a break and off we go again. But I think, Kay, this one's a bit down to the headlines, all this Greenland stuff. The market's probably going to need another catalyst to take it up again. But it doesn't mean we're going all the way back down to 116 or anything.
Mm-hmm. Maybe Davos. The depends how hard Trump wants to go in Davos. It will probably spur a reaction, right? I'm not going to say completely neutral. I still got a bit of a bias towards a shortish dollar. But yeah, I like the way you thought about this move as well. To continue, you need to get above and stick above levels. I mean, it's you compare it to other currencies. It's hard to really see the dollar getting hammered again. I mean, one step at a time, potentially. I also think that we may see buyers on dips even in the euro dollar, but we have seen this so many times of late in FX that you do a move and then it dies out, and we need something fresh. So yeah, maybe Davos, maybe coming out of Davos, maybe those side meetings, because there's probably going to be side meetings. Although with the 3 hour delay that Trump has had due to plane problems, there all those side meetings may be cut short. So yeah, we're going to need something. This this and especially in FX, this we need to really acknowledge that there's many times there's a lack of follow through of all the moves. Okay, vols are one thing, but also I think it's purely the fact that we need very big flows to move FX around, and then especially euro dollar, because it's the biggest currency pair in the world, right?
Yeah.
So it does take flows and fuel to continue. So yeah, for the time being, I agree with you. Whether you trade it long or short, there's always a possibility to make a bit of money out of it, which is really what we are trying to do.
Yeah.
So yeah, I don't disagree at all with what you did, because the level has to go and hold, and then you
Yeah.
can advise what you want to do, right?
Exactly, and it goes back to what I said earlier this week. When we've got low volatility, you have to be. You can have 10 levels on your chart. You have to try and find the ones that you have the greatest conviction for. No conviction for 1720s, whatever in here. This was a conviction line. I will tell you though, if I'd have taken the trade before that spike, there's a good chance I would have been stopped out, because I probably would have done a tight one, 15, 20 pip stop, and I probably would have been blown out in that. So sometimes you get a bit of luck. I didn't enter then, but I thought I'd enter after, and it's going all right for the moment. But I've been talking about that the dollar's been strengthening in a lot of pairs since the last 3 weeks. Well, we've blown it out of the water in 2 days. Does it mean it's over? Who knows? The economy's still doing well in the US, so you're not seeing that falling off a cliff. But yeah, we've undone this bit of volatility, comes back in, and wallop, we get some decent moves. So it's
it's still the case that the vols are low. I'm just looking at the 1 month euro dollar at the money is 565. It's not something where you can expect 2 big figures move in the next 24 hours. I mean, it's a lot about expectations as well, and that coincides with your line maybe there as well. The expectation, you have to manage your expectations in markets, especially in FX these days when you look at those lower vols. If you want to express kind of like a conviction, there may be better pairs to look at than really euro dollar, because you need to know that if when the vols are at those kind of levels, it's still relatively cheap to be long options, and that is creating liquidity at the range ends, the outside range edges. So yeah, it's all about managing expectations right now. The day that the vols are going to really go back up is then we will have to expect more volatility as well, and perhaps a more a faster move to one end or the other of the market.
Yeah, exactly, and that's why it's important that you guys and girls keep your eyes on volatility. I'm always looking at these, the 1 month at the money vols, because that really tells you, it gives you an expectation for price moves. Yes, obviously the last 2 days we've had a volatility injection, but that's come from headlines and comments and whatever. So just because you've got low vol doesn't mean markets aren't going to move, but it's what it does after that when things calm down. As you said, we've seen low vol, all this, yeah, it's come down, 180, 200 pips, but it's taken 3 weeks to do that. All that moves. Even now, call 117.40 is a high. We've only done 40 pips in, the last 12, 16 hours. That's where you're seeing the low volatility. But below, your marker is sort of 6 to 7%. If you're below 6%, 7%, vol is lessening, obviously, but that's when you see impact in the markets. If you're getting above 7%, that's when you start to see bigger daily ranges and the like. Exactly what we're getting in dollar yen. Far wider ranges going on there. That's why if you keep an eye on vols, it just gives you an idea how to trade, what your expectations should be for taking profits and the like. But anyway, euro dollar, it's holding this 17 figure. If we're breaking below that, we'll probably see a bit more air coming out the tyres. But while it's holding here, it keeps this rally in play, and maybe another move up takes out that 40s area, and off we go up towards the high 117s. Sticking with the euro, that one's kicked on as well, blasted through the 86.90, 87 level, kept going, went through the 87.20, hit this fib. We're now just breaking back above 30s. I just made that comment in analysis early on site. We need to get above this fib, this 30s level. If we start holding, that's going to potentially help it further get up to that next area, that 50 retracement. Yes, mate.
There's also a bit of a trend line coming in there if you join those prior highs. Yeah, and it's right around here as well.
There we go. That one.
Yep.
So there we go. We're breaking up above that as well. Okay, there's nothing really in that. Well, you could say there's nothing really in the fundamentals with this one. It looks like it's more of a euro story than anything going wobbly in the pound. Obviously, you could mention it. Euro crosses are all staying pretty perky. Things like euro yen staying up there, euro Aussie and the like. So yeah, I think you got to milk this one while it lasts in case that euro positivity wears out.
Yeah, this time I think it's about expectations. That inflation print today, I've already seen a couple of comments saying that but this spike is not going to last. Airfares, etc., food stuff, and it's going to fizzle out. And I think that's what the market hangs on to right now. To sell a bit of sterling again. Cable is the same thing. Well, I mean, it's even worse now than the euro dollar. But all those rallies are finding sellers quite rapidly in the cable. We're already back to 134 the figure. It's sterling isn't looking very healthy in my opinion, because all those little ticks down in euro sterling got bought quite swiftly. And then you put that in the environment of, as you were mentioning earlier on the show, Bundesbank reviewing the German growth lower, but euro sterling is still bid. So that shows us then that sterling is not finding many friends right now.
Yeah, absolutely. So this one, I'm not going to say this one's going all the way back up to 88, but it's going the right way. I'm still expecting, the UK economy not to do too well, though we still could get some early year positive data points that will keep things ticking along. But back the slice and dice is back in action, because obviously it costs you to sit in this one while it's doing nothing. So I might even have a little tinkle off in a minute, actually. Just take a bit off some of my prior purchases. A quick look at dollar yen, and I'll hand it over to Mr. K. A bit of a stuck in a rut with this one. We keep finding support down in this 157.40s. We keep finding resistance up into his 20s and a bit higher. Definitely looks like, I say volatility is there, but the overall volatility is down a bit in terms of this one keeps shooting higher. Will the MOF be happy with this sort of price action at the moment?
Dollar yen maybe all right, but yen crosses are still not giving back much. It's a bit of a strange one, because every time the real alert levels are there for them to intervene, they seem to hold back. I don't know what they're afraid of. I don't always seem to agree with what's happening in markets either. I mean, I didn't really. okay, I can understand the fiscal spending, and I've been talking about it for so often. But all these like violent ramps higher in the 30s and the 40-year Japanese bonds, maybe a little bit overcried because liquidity in those super long end is has absolutely been slaughtered. There's virtually no liquidity in there anymore because most of the players, including Bank of Japan, are out of there for now. So maybe it's just that the market needs a bit of time to find a new impetus. But fact of the matter is that with the let's say 100 pips or whatever rise in the euro dollar. Or in other currencies, if you look at Aussie, Kiwi, etc., dollar yen is still hanging around 158, so the market hasn't given up the bone just yet.
Yeah, so I think you can probably stick with this range for a while. This 157.40s up to this 158, 80s, 90s, and if you're moving outside of that, we're either going to test this high or we're going to test the big 157 again. So there's a bit of room to play with in here if you want a bit of range trading. Right, handing it over.
Okay, excuse me. I'm going to have a quick look because I'm watching the clock here. Um, some stuff that we talked about in the room, that talked about also on prior shows. This is Aussie dollar. The 68, 25, 30-ish, we came back into it yesterday and really early days in Asia as well. It's kind of holding on the very short term, 67.25 or 2030, call it, on the Aussie. It's kind of positive that we're holding there. We're not making too much headway, but it's also while it holds, and depending on what's going to happen with the dollar this afternoon, it could be that we have a little push through that higher level here that we saw early January, and go for a look at 68 and a quarter, providing there's enough bearishness in the dollar. And also, the reason I show it is that tomorrow, very early morning, our time, we are going to get the Australian jobs report. So I think we should take this 67, 20, 30 as a bit of a hinge of what could happen over that report. But if we, let's say, close the day over there, but then the report is better, we could actually start pushing towards the 68 and a quarter. In turn, obviously, if we get closes or the move below this on the Australian jobs report, we could get back to 66, 85, 90 or so, where the major support of the past month, over a month right now, is obviously 66.60. Okay, in case of a weak one. But if we get a decent report, the market, let's not forget, is still toying with the fact that RBA could actually remain a lot more hawkish than any other central banks out there. So it could be a tailwind for the Aussie dollar. And Ryan also brought this up yesterday in our room. 115 and a quarter, Aussie Kiwi. It could be enough, and that's also, I think, going to be really decided by tomorrow's jobs report. It could be enough as a retracement because it's holding above the 61.8, which, in my opinion, is going to be a bit of a line of no return. We could have a bit of a shakeout there, but if you go under the 61.8, this move, this really whole move could actually fizzle out again and go back down to low 114s or 113.90. So it's an interesting zone. And I guess if we get a decent jobs report tomorrow, this could start to push back higher. And higher, I mean, by that back above 115.80, 115.90, 95. If that goes, this will just have been a retracement, and we may start to push up towards those higher levels again. It's a very interesting level. So quite a few people in our room were looking at that as well, at that 115 and a quarter. Take a confirmation level maybe around 115.07, 08. That's really the zone that we'll have to hold in stuff like Aussie Kiwi if you're interested in trading that pair, which could be an interesting one, because as we always say, there's not only the dollar that being traded in the market. If you want to steer away from any dollar positions, stuff like that, those kind of crosses can be interesting, just as euro sterling can be, for instance, right? And to finish, yeah. That extension is just a line on the charts. When geopolitics drive markets, that's what happens with technicals. But okay, we have an extra one to admire, around 49, the figure, and I trust that the 5,000 hats are getting readied left, right, and center, which is going to be obviously a very big psychological level if we get there. At the speed we're going here, this could be a case that we are there after the Trump speech before the weekends. Again, we are still in the same kind of pattern. We're finding bids on any retracement level and even before. So for as long as that lasts, very hard to see really deeper retracements. If you want to look at the level today, there's not a lot before 47 figure 20. That's going to be the thing. If ever the pattern has to be broken or going into a pause, like I updated in the room earlier today, we are going to have to first start to get below 4,700, and then obviously even 46 and a quarter, that gap here around here, and then the 45 and a half should hold below as well, which it didn't, as we have seen last Friday. So for as long as that lasts, yeah, the next step is probably going to be 5,000. But I'm not in it right now, because imagine the slightest positive headline somewhere, as it's gone so parabolic again since the start of 2026, could see these kind of moves like we saw at the end of 2025, and all of a sudden a bit of a vacuum, a bit of a I don't want to chase it here anymore, and we could see this kind of move. So for the time being, I'm not chasing this here. And with that, Ryan, back over to you, mate.
Thank you very much, mate. And thank you, everybody. Try and have a good day. Boys and girls, don't get caught out by any headlines, or try not to get caught out by any headlines. Don't forget to catch us later on Face as well. Other than that, have a great rest of your day, and we'll see you tomorrow.